Hi, this is Gary DeWaal's Bridging the Week, December 9th to 13th, and today is December 16th, 2013. Good morning, and I hope you had a nice week. One dominant story involving the Volcker Rule and many other stories fill out international developments involving financial market industry participants last week. The stories may seem disparate and of widely different colors, but in fact there are some common themes and ultimately brought together as in a kaleidoscope. The principal themes this week are market structure and financial market utilities, internal controls and supervision, and personal accountability. But let's see if you agree with me by the end of this video session. Last week, 5 federal agencies issued rules to implement the so-called Volcker Rule under the Dodd-Frank law enacted in 2010. These rules generally prohibit banks and their affiliates from trading on a short-term proprietary basis for their own account certain securities, derivatives, futures, and options on these instruments. Subject to certain exemption, the rules also articulate strict limits on banking entities acquiring or maintaining an ownership interest in, sponsoring, or having certain relationships with hedge or private equity funds. The 5 agencies are the Board of Governors of the Federal Reserve System, the Commodity Futures Trading Commission, the Federal Deposit Insurance Corporation, the Office of the Comptroller of the Currency, and the Securities and Exchange Commission. Despite their prohibition, the rules grant exemptions for certain proprietary activities, including trading in U.S. government and certain non-U.S. sovereign or their political subdivisions obligations, market making, underwriting, risk mitigating hedging, and organizing and offering hedge or proprietary equity funds. Acting as an agent, broker, or custodian is also permitted. Similarly, trading on behalf of customers in a fiduciary or riskless principal basis, as well as activities of an insurance company, are also permitted under certain circumstances. These exemptions are limited if they involve a material conflict of interest, a material exposure to high-risk trading strategies or assets, or a threat to the safety and soundness of the banking entity, or to overall U.S. financial stability. Express requirements are imposed by the rules for each banking entity engaged in authorized trading activities or investments. These include establishing a compliance program, limiting positions, inventory, and risk exposure to ensure activities, quote, do not exceed the reasonably expected near-term demand of clients, customers, or counterparties, end of quote, limiting the duration of holdings and positions, defining escalation procedures to modify or exceed previously approved limits, ensuring senior management accountability, and limiting incentive compensation. Although final rules are effective April 1st, 2014, bank entities are permitted until July 21st, 2015 to comply with the rules restrictions. Reporting obligations will commence as of June 30th, 2014, however, for the largest banking entities, while other banking entities will not be required to commence reporting, depending on their size, until one of 2 dates in 2016. Last week, IOSCO issued 2 studies, one related to regulatory issues raised by the evolution of market structure, other than derivative markets, and the other regarding incentive fees provided by exchanges and other markets and their impact on trading behavior. In connection with the report on market structure, IOSCO noted the benefits of increased competition because of the proliferation of different types of trading spaces, namely exchanges, non-exchange trading market systems such as automated trading systems in the US and multilateral trading facilities in Europe, and OTC trading systems, but observed that as a result of this proliferation, fragmentation of markets is an increasing trend. This fragmentation raises a number of concerns, including, quote, 1, the duplication of costs, including search, operating, and regulatory costs, the introduction of trading methods and business practices that may diminish efficiency and not be in the interest of the market as a whole, and 3, the dispersion of liquidity that could result in less efficient price formation and in higher volatility, end of quote. As a result, IOSCO issued recommendations including that national regulators should 1. Regularly monitor the impact of this fragmentation on market integrity and efficiency to ensure that regulatory requirements to protect investments and ensure market fairness are still appropriate, and 2. Regularly evaluate different rules applicable to different trading spaces to assess comparability. In connection with incentive fees, IOSCO pointed out the need to consider the potential of conflicts of interest in routing decisions because of multiple marketplaces charging different fees, and the potential of fees to, quote, distort the market where trading is based on differential between fees and rebates rather than the pricing of a security, end of quote. However, IOSCO said that its study of incentive fees did not provide sufficient, quote-unquote, clear evidence to arrive at any definitive conclusions and therefore did not issue recommendations as part of its effort. And a few shorter articles. First, the Financial Industry Regulatory Authority, or FINRA, fined Oppenheimer Co. $675,000 for markups on municipal securities that were unreasonable and for having an inadequate supervisory system that failed to detect the very high markups. David Serrani, Oppenheimer's head municipal securities trader, was also fined $100,000 and suspended for 60 days. As part of respondent settlement, Oppenheimer also was required to pay in excess of US $246,000 in restitution to customers. The excessive markup occurred from July 1, 2008 through June 30, 2009, during a time when the firm's surveillance reports only captured intraday transactions to evaluate the fairness of markup and markdowns, while if a trader purchased municipal securities and held them in inventory a day or longer, the subsequent sale would not be included in the surveillance reports at all or be evaluated for fair pricing. The important news of this article was the fine and suspension of the head municipal securities trader at Oppenheimer. Personal accountability. Tough. This is tough. Second, claiming it is responding to new CFTC and international regulatory standards regarding liquidity arrangements, ICE Clear US announced it is changing the way members are charged for collateral and cash management activities. Beginning January 1st of next year, ICE Clear will assess a 5 basis point charge on clearing member U.S. Treasury security balances calculated daily and accrued monthly. This replaces existing transaction-based fees. Also, beginning early 2014, ICE Clear will utilize external investment managers to manage cash posted by clearing members for initial margin and guarantee fund deposits and retain a portion of all interest earned on cash balances. ICE Clear estimates its cash management expense will be 6 basis points, again calculated daily and accrued monthly. It warns members that investment returns may be negative in low interest rate environments. Investment returns will be credited to or debited from members on a monthly basis. Isn't this a clearinghouse that next year is requiring clearing members to post 50% of the guarantee fund deposit in cash? Do regulators really require this type of pricing scheme? The U.S. National Futures Association has proposed to amend its rules to accommodate post-trade allocation of orders by futures commission merchants and introducing brokers. Previously, only commodity trading advisors were authorized to take advantage of such procedures. Only FCMs and IBs with written investment discretion by their customers may take advantage of these procedures and may not include any proprietary trades in a post-trade allocation, although CTAs may continue. The NFA submitted this rule proposal to the CFTC on a 10-day review, meaning it will implement the rule unless the CFTC objects within 10 days. The UK Financial Conduct Authority fined Lloyds TSB Bank plc and Bank of Scotland plc both, by the way, part of Lloyd's banking group, 28,038,800 Great Britain pounds, which is approximately 44 million US dollars, for imposing on their sales staff a payment incentive scheme that pressured them to hit targets to achieve bonuses or not get demoted, rather than to act in the best interest of their retail customers. The Financial Conduct Authority acknowledged that although a comprehensive study of the impact of these sales activities is now underway by the banks, it is possible that, quote, due to increase in the value of stock market since the start of the relevant period, actual customer detriment from any unsuitable sales of investment products may be low, end of quote. The Financial Conduct Authority considered this not relevant in evaluating the problematic conduct at issue. By the way, the fine assessed here is the largest ever in the history of the Financial Conduct Authority or its predecessor, the Financial Services Authority, for a retail sales abuse. And finally, the U.S. Securities and Exchange Commission settled with a London-based hedge fund advisor, GLG Partners LP, and its U.S. holding company, GLG Partners Inc., for approximately $9 million US dollars related to charges that GLG did not have proper internal controls to properly value assets. This failure resulted in an overvaluation from November 2008 to November 2010 of an investment of 20% of the assets of GLG Emerging Markets Special Assets 1 Fund in an emerging coal company and the payment of inflated fees to GLG firms. Clearly, a breakdown of internal control. Well, that's it for this week's Bridging the Week. Do you agree with my assessment of themes? In any case, until next week, have a great week, enjoy your holiday parties, and ciao, see you soon.